Welcome everyone, thanks for joining. We have a lot to catch up on in this video. We have a lot of subjects to go over, one of which of course is my portfolio, if I can bring it up here. It's called the Story Fund, that's what I named it, and it's on a platform called M1 Finance. This is a highly aggressive growth-centered portfolio. And by aggressive and growth, I mean I'm focusing on companies that are growing their top line revenue at a steady pace, and they're growing market share. They're not just companies kind of moving along, with the rest of the market. These are ones that are growing at a faster pace. So that's what I mean by a highly aggressive growth-centered portfolio. Now, I want to talk about this, give it an update. We'll compare it against the S&P 500, but I also want to talk about this portfolio in the context of the reopening of the economy. We have a lot of articles coming out showing how powerful the reopening of the economy is. The economy is very hot. There's lots of jobs hiring right now, pay's going up, businesses are booming right now, people have money in their pockets, everything's going good with the economy. And when the economy is transitioning from being mostly in lockdown and people in their homes to reopening, it does have an effect on portfolios like the Story Fund, growth-centered portfolios, especially tech-centered portfolios. So I'll be commenting and sharing some thoughts on that. Now, on some other subjects related to one of the holdings in my portfolio, which is Apple, we're also going to be talking about some things related to this stock. One of them is Apple received a downgrade from an analyst, and not just a small downgrade, but he's predicting a 30% decline in Apple's share price, down to almost $90 a share is what he's predicting by next year. I have over $35,000 invested in Apple, just that one company, not counting any type of index fund or anything. That's an individual investment into Apple between both my portfolios. So when I see articles like this saying Apple gets rare sell rating as this new analyst is downgrading it and predicts a 30% stock decline, well, I want to listen to his case. I want to see if he knows anything that I don't know. So we're going to listen to his interview on CNBC, and I'll give you my reaction of what I think about his case and his prediction for this enormous stock decline that he's predicting. Now, related to Apple, we're also going to be looking at this story. Epic and Apple, the verdict is in. Well, at least the predicted verdict. So they don't know for sure. But in this article, what they did was they contacted a lot of people that were like former judges or former lawyers or people that work in the sphere, experts' opinions, and they got a bit of a consensus of what they think most of them think is going to be the verdict, what the judge will rule. People familiar with this judge and her prior cases and who had viewed the whole trial, how they think this is going to pan out. So we're going to be looking at that as well. So we have a lot to jump into, a lot of subjects to cover. If you like this type of content, as always, it helps out the YouTube algorithm to smash the like button, subscribe to the channel. The little bell icon makes so you get notifications when I post videos. And if you really like this type of content, you can consider the Patreon. It gives you access to a bunch of different stuff. We're developing apps. We have different websites for investing, a Discord community, exclusive episodes, a bunch of different things. There's a link in the description, or it's patreon.com/Joseph Carlson, and you can try that out for a month for free. Now, let's first of all jump into the Story Fund. This is my growth-centered portfolio on M1 Finance. So far, the performance has been, I would say, a little underwhelming. I mostly have companies that, like I mentioned before, they're technology companies. And I'm invested in these for the long term, so I'm not playing different macro factors. That's not the purpose of this portfolio. But right now, tech companies aren't really in. They were in 2020. Now they're out. They're not the hot things to invest in. In fact, if we look at my portfolio, which has a lot of the leading SaaS companies, cloud companies, technology companies, these are the ones that I've outlined that I think are the highest quality, that have the most potential for outsized returns. If I compare this portfolio to the S&P 500, this is where we're currently at as of about an hour or so ago. So my portfolio is in blue. You can see that for a while it was way above the S&P 500. Then we had the rotation of big money out of tech into the recovery plays, and that brought it down to where the return right now is 10.5%. While the S&P 500 is 15%. So if I had invested my money in SPY right now, I'd be ahead. But 3 months ago, I would have been ahead in my portfolio. So we'll see how this plays out over time. But like I mentioned, the biggest thing that we're facing right now, and I think something to be aware of, is right now the economy is reopening. And by every report, by every estimation, it's reopening much stronger than originally anticipated. In fact, there's a lot of articles like this one in the Wall Street Journal that says the economic recovery is here. It's unlike anything you've seen. They go on to outline how powerful this economic recovery has been so far. They say the U.S. economic recovery is unlike any in recent history, powered by consumers with trillions in extra savings, businesses eager to hire, and enormous policy support. So you have this culmination of the Fed support, of the central government, of all the stimulus checks, all the PPP loans of businesses, and everything to sustain the economy during the 2020 lockdowns. And then we have people with a lot of extra savings. They're going out and spending money. And we have businesses with more demand than they've ever seen, so they're hiring more people. And this is all great stuff. I'm not complaining about this. In fact, I'm very happy that the US economy, at least, it's very hot. It's opening up faster than expected. People are working. And this is far more preferable than people looking for work and not being able to find any jobs because nobody's hiring. That's the worst situation. So I'm glad that the economy is very, very hot right now, and it looks like we're going to have a strong recovery. There's even people saying the turn in fortunes has been head spinning for a lot of businesses. At the Atlanta Farm to Table restaurant, Miller Union, executive chef and co-owner Steve Satterfield can't hire fast enough to keep up with the sudden onslaught of business after months of struggling due to the pandemic triggered slowdowns. So this restaurant owner is mimicking the same feelings that a lot of restaurant owners have, that just a few months ago, they were having trouble with demand, and now they're trying to hire as many people as they can because they can't keep up with demand. So that's a good thing to read. I like reading stories about that. I'm glad that the economy is reopening, but it does affect the markets and how big-time investors are positioning, how they're positioning their portfolios. For instance, right now, reopening bets are paying off big for stock pickers. So the people that like 3 months ago shifted out of all the technology holdings and put their money into these reopening holdings, like I think they have a list of them here. They have, let's see. Yeah, L Brands, Marathon Oil, Devon Energy, Gap, Diamondback Energy, Ford Motors, so on and so forth. These are considered the reopening companies. These are the ones that have done well over the past 3 months. And the investors that have foreseen this and they position their portfolios into those reopening plays before big money did that, well, they're the ones reaping the rewards of that. They're the ones doing that. The Story Fund, on the other hand, and portfolios like the Story Fund that are technology-centered portfolios, well, these are out of favor right now. They're the ones that people are rotating their money out of these for those reopening companies. But I think it's only a matter of time before investors return back to these stocks and look at them as the center of the economy, the center of growth, the center of the future of investment funds. Because I think that these companies aren't just pandemic companies. Apple didn't do good just because of the pandemic. Neither did Google or Amazon. They may have benefited a little bit from it, but a lot of these companies, I think, will show that they are the dominant companies even outside of a pandemic environment. Even when the economy's open, these are ones that will drive a huge percentage of GDP. Whether or not people are indoors or outdoors, they're going to be using technology. So I feel completely fine keeping invested in these portfolios. And I'm not the type of investor that constantly be moving my portfolio from tech or to something else based off of these macro predictions. So I'm going to stay invested in tech. And in fact, as more money leaves these companies, as the rotation has been happening, I've been putting more money in them. So as they go down to more reasonable valuations, as there's less enthusiasm priced into them, that's when I decide to dollar cost average more into these companies. So I've been doing that over the past couple months. Now, we'll see how this goes in the future, but right now, we're still a little bit behind SPY. I still feel fully confident over the next 5 years. I have a very good chance of outperforming it. Now, let's go ahead and change subjects a little bit and address this story right here. Apple has received a downgrade from an analyst that predicts, or he gave it a sell rating, first of all. He's telling you to sell out of Apple. That's what the headline of this is. And then it's going to drop 30%. So that's a substantial drop for Apple. Now, this is a jarring prediction for me because I think that Apple, being priced at a similar PE as the rest of the stock market, is very reasonably priced considering how dominant and how good of a business it is. So when I see a professional, an analyst that does this for a living, give a company like Apple a downgrade as well as a sell rating and a 30% stock decline, that's something I want to pay attention to. That's something that I want to look at. So let's go ahead and jump into this interview with this very analyst. He calls in the CNBC and explains his sell rating on Apple.
Hi. That's actually, Kelly, expectations for the iPhone 12s, the one I call the iPhone 12s, and which doesn't have a name yet. And that.
Okay, let me just address this. Let's just get this out of the way to begin with. I know you guys are probably thinking the same thing when you're watching this. Our guy here has AirPods in his head as he's making the sell call on Apple. He's literally got their products in his head right now. He has AirPods on. He has an iPhone in his pocket, guaranteed. He has an iPhone in his pocket as he's making this call, or on the table, right, on his desk. He's looking at a MacBook. He's looking at an iMac. That's what I'd be willing to bet. I'd bet $1,000 that he has an iPhone either on his desk or in his pocket right now, and he's staring at a MacBook or an iMac. I don't know for certain, but I'd be willing to wager $1,000 on that bet. And he's got their products in his head right now. He has AirPods on when he's making this call. Just kind of funny to point out. And I know Apple could be overvalued even if you use their products. I get it. But I'm pointing this out that even the bear on Apple, even the guy telling us to sell it, is literally using the products of the company as he's saying to sell it.
That is going to be announced in September. What we see today is that demand for the iPhone 12 is actually exceptionally strong. So what does that mean? That means a phone introducing 5G, a return of the metal frame on the case, has introduced a lot of changes in look and feel and a lot of innovation, and has driven a lot of interest. And that's bringing forward replacement. So a lot of people who normally would have replaced their phone next year are actually going to replace it this year or.
This is always the bear case for Apple. For the past 10 years, this has been the bear case for Apple. Wow, they're doing so good right now. They have so much demand right now that they can't sustain this level of demand into the next year, the year after. That's always the same thing. He says that the problem with Apple, if this is the bear case for Apple, is they're doing too well. They're doing too well right now. They're selling too many phones, and they're definitely not going to be able to keep this up in the future because people like their products so much that they're buying all of them now. They won't need them next year. They call this pulling demand forward. So you have demand in the future, and you're pulling it forward to now. I think this is one of the weakest arguments for almost any company, the pulling demand forward. It can happen a little bit in some very unique cases, but most of the time, a company that did well 1 year should continue to do well into years into the future. And even if it has some times where it goes through a little bit less demand, it evens out over time. So this pulling forward demand argument is very common with Apple. It's common with a lot of other companies. But in Apple's case, I don't buy it. I think that Apple will have plenty of demand next year and the year after. But let's go ahead and listen to him make the rest of his case.
Are replacing it now. And this is really where I see the weakness. On the back of this very strong level of replacement today, in 1 year from now, we'll see an air pocket. We'll see far less people in the market buying iPhones. That's the essence of the call.
And so again, to clarify, you're saying that iPhone 12 demand has been so good that for the next refresh in the fall, there's no way that it can compete or hit the numbers that the street is expecting. So let's play this out to how that turns Apple from 120 something.
She's exactly right. He's just saying demand's so good right now, it can't possibly be that good next year. Now, we go further into this interview, and he tries to explain his price reduction on it. So let's listen to this.
130 million phones next year and sell 234 million phones next year, slightly up from what the market expects for this year. I expect that number to come down, maximum at $200 million units, and even potentially a bit less than that. I see the downside risk down as much to 180 million. So if that happens, what happens? Everybody on Wall Street is going to adjust down their expectations for 2022. And, iPhone shipments being 15-20% below where expectations are today means earnings expectations for next year are going to be a good 10% below where they are today. Mm-hmm. And historically, what you see that when that happens to Apple, it has like a temporary but very significant impact on the multiple on the stock. So if your earnings come down 10%, your stock price can come down 30% because your multiple is going to come down.
Okay. So let's just piece together what his prediction is and what his sell rating is reliant on. It's first of all reliant on demand being pulled forward. So that's one assumption right now. I think that's an okay one, that some demand's being pulled forward. But that's one assumption. So you have the assumption that Apple, because demand's pulled forward, they're not going to hit their expectations with iPhone sales next year. That's the next assumption. They're going to miss expectations because demand was pulled forward. They're going to sell, 30 million less units or something next year, is what he was saying. And then because of that, because of the iPhone sale reduction, you're going to have a 10% reduction in the earnings over what they're expected, which, if that happens, his prediction is based on a 10% earnings change with the analyst predictions, the stock will fall 30% because the multiples will compress on Apple. This is the sell rating for Apple. This is what you have to do to get to the point where you have a sell rating on the company. Demand is so good right now, it's going to be pulled forward. Because it's pulled forward, they're going to sell 20 or 30 million less units next year. Because they're going to sell 30 million units less next year, their earnings is going to go down 10%. And because the earnings is going to go down 10%, the stock price is going to fall 30%. Just wanted to piece that together. That is the bear case on Apple from one of the only bears out there on the stock. So let's see if he has anything else to add to this.
Now, in the longer term, on a 3 to 5 year horizon, I do agree with you, Kelly. It's no big deal.
On the longer term, on the 3 to 5 year horizon, I do agree with you. It's no big deal. Oh, there's a slight caveat to add in there. After giving this shocking headline, this is a shocking headline if you're an Apple investor. In fact, if you're just a headline reader and you're browsing through the news and you see this pop up and you own a lot of Apple stock, this would instill fear in you. You'd think that you need to sell out of the company because there's professionals saying it's going to go down 30%. That's what the message would be. But the analyst himself giving this sell prediction has concocted 5 different things that have to happen for it to even have that 30% stock decline. And then even in that case, he says over the next 3 to 5 years, it's no big deal. He says 3 to 5 years, a 30 million miss in 1 year of iPhones shipped is like nothing to Apple. It really doesn't even change the bottom line that much. And it's something that Apple would quickly recover from if they have another good phone cycle afterwards. So these type of headlines, this is what you have to be careful about, is read the context around them. Some of the analysts are so short term. He's saying that it could possibly have a 30% stock price reduction next year if these 5 things happen. And even if his analysis is correct, it's not a big deal in the long term. That's what this headline really reads. So that's why I like to look into these and investigate when analysts come out with bear cases on stocks or sell ratings. I like to see their actual thoughts on it because many times it's not quite as bad as it seems. They're looking at very short-term things that in many cases I think are highly unpredictable and improbable. In my opinion, this is a very improbable scenario because Apple, it's trading at a market average multiple. I think it's a far superior business than the rest of the market. In my opinion, it should receive a multiple expansion based on how fast the service business is growing. But regardless, that is the story for Apple. That is their downgrading. Now, on the subject of Apple, we of course have the Apple versus Epic, the predicted verdict. So this isn't the real verdict. We don't know what the judge has decided, but this is what experts that were contacted by MarketWatch. They went and they asked the opinion of a bunch of different experts familiar with this case, people that know the judge and they know how she's ruled on prior cases, or they know how this usually works out. They got their opinion. And they say experts who observe the trial expect the judge will not rule completely in favor of Fortnite. And that's a big thing. So Apple's not going to be ruled against completely, but they could seek to force changes to the Apple App Store when she decides the results of this landmark case. So it's kind of an in-between situation. We don't know for sure what's going to happen, but we don't think that it's going to be a complete ruling against Apple. They say, throughout closing arguments on Monday, the judge signaled that she was troubled by the monopolistic forces at work in the iOS ecosystem, but acknowledged that federal courts don't run businesses. I think the monopolistic practices or forces at the iOS ecosystem that the judge is referring to, as she said many times throughout this trial, that she does not think that Apple is setting their prices for the iOS ecosystem, for the App Store, based on competition. She says that they could basically price it whatever they want because they have such a strong hold on the market. Now, I disagree with that to some extent because I do think that Apple wants to not look super out of line with their pricing. So they do look at what others are pricing their stuff and they set it based on that. But I do agree that they don't have to. The only reason they're doing that is to prevent having government regulation. They say how she defines the relevant market in this historic case could lead to remedies that push narrow, nuanced, prescriptive measures, but none of the experts, not a single expert that MarketWatch spoke with, expected what would be an outright rule that Apple is exerting illegal control over monopolies. So that's the big one that Epic Games is going for. And they do not believe that the judge is going to rule in that favor. They're not going to say that Apple is a complete monopoly. Now, there's lots of different expert opinions on this, and a lot of them do vary. Like, they don't agree with each other. This one, for instance, says the judge will rule in Apple's favor because the law is clearly on Apple's side. So this expert witness is just saying Apple's right. The judge should rule with Apple. Quote, and she, like other judges, does not want her decision to be overruled. So if the judge steps out of bounds and rules against what prior law and precedent has set the standard for, her decision could be overruled, which I think would be a little bit embarrassing. So she doesn't want that to happen. So she's probably going to have a more nuanced ruling, right? Not one that goes against any type of prior precedent. Later on, it goes over more opinions, says the prescriptive measure that could address the 30% commission fees or seek alternatives to Apple's payment system are more likely than full ruling against Apple's, experts said. And that's kind of the takeaway, is they believe that there's going to be some minor changes to Apple's payment system or their 30% commission fee. In my opinion, I think that Apple should reduce their commission. I think that 30% is a lot for what essentially amounts to a payment processor. They do some work and they employ people to go through and verify the apps and make sure it's running well. They've invested a lot in it, but really they're taking 30% of all the digital income of a lot of different apps. That's a lot of money. And that's basically for running a payment processor. So I think that Apple could reduce those fees. And other people bring up the counter argument that YouTube, for instance, takes 45% of ad revenue. So of this video, they're going to take 45% of the ad revenue. I'll take 65%. That's the split. And that's a worse split than Apple's 30%, right? Or you can even look at Twitch. Twitch takes 50% from their creators, the people that are streaming. They take half the revenue. So when you compare it to Apple's 30%, it looks like Apple's is more favorable. The difference is that what YouTube is doing is hosting millions of high definition, huge files and streaming them, which costs an enormous amount in hosting and server fees. Apple's not really doing that. And a lot of times they have companies like Netflix where they're just hosting an app, and Netflix is the one paying for all the servers, all the hosting of their stuff. Apple is literally just hosting the app interface. So I think in some cases, the argument against Apple's fees are necessary. In my opinion, I think that this is already priced into Apple. I think that they're already aware that they're going to have to reduce their fees eventually. I think it's an eventuality that Apple will reduce their commission fees. Only a matter of time. And I think that at Apple, they've probably priced that in. They've made adjustments to their business. They're growing revenue in so many different places that this one revenue source being a little bit lessened by a percentage, I don't think is a big deal. If it goes from 30% to 15 or to 10, I don't think that's going to destroy Apple. I wouldn't sell the holding because of that. They have so many ways to make money. And in my opinion, lowering their fees actually could create more goodwill with investors. It could create more equity for the investors or the people that are, for not the investors, but the developers and the people making products and stuff on their app stores. So I think in a lot of ways, it could be a good thing for Apple. But that is a story right now. They don't know the outcome, but the predictions are that's going to be somewhere in between. They're probably going to do some requirements of their fees. They might make it so that Apple has to let developers be able to say, hey, you can sign up online. Maybe that would be a change. There's a couple different things a judge could do that would be in between, but they strongly do not believe that they're going to rule that Apple is using a monopoly in an illegal manner, which would be a huge ruling against Apple. And if they had to do anything drastic like that, it could be devastating to Apple as a company. And I don't think that the judge wants to do that, because if they did everything that Epic is wanting to do, it would wipe hundreds of billions of dollars off of Apple's market cap. If they really made it so the App Store was exactly like Google's, you could install any payment processor, any app could be installed on it. It would completely change the experience of the iPhone and make it less there wouldn't be such a distinguishment between iPhone users and Android users. People wouldn't be able to pick differences. They just have two Android markets. So I don't think the judge is going to do that. I hope they don't do that. And I think that if they do anything aside from that, I think Apple will be fine. The only time that Apple will be in trouble is if this judge does something completely radical out of left field that'll probably be overruled in different courts. So it's, again, something I'm not too worried about. But that is the latest on Apple. I hope you guys enjoyed this little video update. I'll have another video update on the Story Fund later this week. So if you haven't already, consider subscribing, following along, and I'll talk to you guys soon.